Welcome to the AACFB's 2021 Meet the Funder webinar series. My name is Monica Harper. I'm the Executive Director of the AACFB and I will be your host. Our presenters today are Stacy Allen, Adam Peterson, and Brad Peterson from Channel Partners Capital. Channel Partners Capital is both a funding source member and a gold sponsor of the AACFB, and I'd like to thank them for their support of the association. Before I introduce Channel Partners, I'd like to go over a few items to make this webinar more enjoyable and informative for everyone. During the presentation, you should see a Q&A box that will allow you to ask questions. If you have any questions during the presentation, please submit your questions in the box and they should be answered by the end of the webinar. The entire webinar should take no more than about 30 to 45 minutes. For those of you who would like to review this webinar on a later date, it will be posted on the 2021 Meet the Funder page of the website and be emailed to AACFB membership. At this time, I'd like to turn it over to Brad. Brad, it's all yours.
Thank you, Monica. Adam, if we can go to the second slide. So today you've got myself, Brad Peterson. I lost the slides. Hang on. There we go. All right. That's an old guy technology issue. Don't press that little one bar. So anyway, we got Brad Peterson. And then Adam is joining us and Stacy Allen. Stacy joined Channel last January to help us pursue the equipment finance business that we'll talk about some. Cindy Fleck would have loved to have been on the call, but she's got some family responsibilities back in South Dakota today, so she's not going to be able to join us. The only thing I would point out on this slide, other than how handsome Stacy and Adam are, is that the guy on the left seems to fill up the frame more than he used to. I don't. Every time they take pictures of me, I think the camera keeps getting closer, which is kind of embarrassing. Anyway, Adam, if you could go to the next slide, I'm gonna just quick start with an agenda and give just a quick update on Channel. Before we go to that, Adam, I want to go back. We are big supporters of AACFB and have been for many years, and dating back into the NAELB, not NAELB times. And we are going to take a list of the folks that have participated here today and draw out 10 names to pay for your conference fee for Nashville on September 8th through 10th. This is maybe these times are more important to network with others and see how things are going and where things are working and maybe where things aren't. But we think it's important to get to Nashville and things are opening up, and that's great. And we want to support everybody's that can get there to be a part of that. So we're going to do that. Adam and Stacy are going to give an update on equipment finance and on working capital and some other things. And I'm just going to quick talk a little bit about Channel and the state of the ship, if we will. So Adam, if you can go to the next one. We look at our business as really the only on balance sheet lender offering both equipment finance and working capital solutions exclusively through partnerships with equipment finance companies like yours. That's what we do. We do not, and I'll talk in a minute, we don't have any direct business. We don't have any vendor business. We work exclusively through equipment finance companies. And we have since we started. We established a business in 2009. We're headquartered in Minnetonka. That's Minneapolis, Minnesota. We have expanded in the last couple of years. We have offices in Atlanta, in Des Moines, and in Marshall, Minnesota. And Stacy makes sure I always say we have an office in Grand Island, Nebraska. If you've ever been to Grand Island, there's a chance you never went back. Okay, I'm just saying. I don't know that for sure, but that's Grand Island, actually nice place out in the middle of Nebraska. We're nationwide on balance sheet. The I don't know, Adam was kind of a little short on the T's apparently. We have 90 employees now. We do both equipment finance and working capital, $10,000 to $250,000. Stacy and Adam will talk about that in a minute. We don't have any direct lending group. We originate all of our business exclusively through equipment finance companies. Since we started in 2009, Adam making some calls out of his dorm room back then on behalf of some partners. We funded over $800 million, 8,500 businesses, 15,000, more than 15,000 individual loans. That's a long time, 12 years of doing this. Probably more importantly, today we're over $50 million of equity. We have $250 million in debt facilities that support the business. We will do our first securitization late August, early September, and in the month of June, we did nearly $33 million of funding. We don't normally talk about those numbers, but I think as Stacy and Adam talk, I think it's important to kind of know the scale. About a third of that is the equipment finance group that Stacy is a huge part of, that we started only in August last year. So we're 10 months, 11 months in. The next page, kind of how we think about ourselves. We deliver non-disruptive approach to providing your customers the financial solutions they need. Okay, you're all already in the equipment finance business. Some hold a portion of their paper, and some syndicate all that they originate. We work with both models. Some of the largest bank-held leasing companies in the United States are amongst our biggest customers, and down to folks that have maybe working out of an office in their home and 1 or 2 employees. We do it all, and we try to adjust our business model to your processes. That's to understand and connect part of what we do. We are a single source, so now we do equipment finance, 5 different tiers. Stacy will talk about that. We do working capital, a broad range of working capital. So one-stop shop for that is kind of how we view ourselves. We're tech-enabled and really data-driven. We now have 3 data scientists with crazy degrees working for us and building the models, and they've done really a terrific job, particularly on the working capital side. And they've done some really neat things with a lot of data we purchased on the equipment finance side. But we're good at that. We're really good at that. And we're really good at the data analytics and the numbers after. But most importantly, as we think about our relationships, we want to make sure that we win together, and we're committed to your success in every step and everything that we do. Our filter is, what's it going to mean to our customers? So that's channel in a maybe a slightly more than a nutshell. Adam, you're up.
Yeah, and just to piggyback on Brad a little bit, we really focus on being differentiated in the marketplace. We are not a black box underwriter. We want to come out. We want to really understand your business, understand how a deal flows through your shop, and figure out ways that we can integrate in a non-disruptive way that adds value to your business. So we're not one of those lenders that comes out and says, hey, here's how we do things. This is our process. We want to work to customize processes that add value to your employees, to your vendors, to your end users, that ultimately, like Brad said, help us win together. So that's really how we evaluate all of our partnerships today is how do we win together. With that said, I'll flip it over to Stacy to talk a little bit more about our specifics of the working cap, or the equipment finance side.
So Brad kind of stole my thunder because I was going to introduce myself, but then he did. So for those of you that don't know me, my name's Stacy Allen. I've been in the equipment finance industry for about a little over 7 years. And as he said, I joined Channel in January of this year. I feel very fortunate to be a part of the team. It's a great team to be working with, and I'm excited to be able to still work with the same partners that I've been doing business with for the last 7 years, and being able to continue to build on these relationships and help you guys grow and help, which in turn helps us to grow. We launched the equipment finance division in August of 2020, soft launch. Full launch was just in January of this year. So, we're less than a year into this. Some of you may already be doing business with us, and some of you may not now, but hopefully in the future, there'll be some opportunity. A little bit about our equipment finance program, is we're a risk-based price. We have 5 pricing tiers, and each of those tiers has a sub-tier. Our rates start as low as $589, and we go up to $17.25. So, we consider most credit types from A to C, as known in the industry, A to C credits. Our pricing is based on our scoring model, but all deals are still underwritten by a credit underwriter. Equipment types, we can do anything from construction to manufacturing to titled equipment and anything in between. As long as the equipment is business essential and it makes sense, we can consider it. I would say we're a generalist when it comes to equipment types. We don't specialize in any specific industry or anything. Our minimum deal size is 10,000, and we can go up to 250,000. We're app only to 150, and we're true app only, where we just need the application and the invoice or equipment type and amount requested. I would say that our sweet spot is probably 150 and below. I think we're probably better at those types of deals, but we can go up to 250. Technology. So we have an online portal that allows you to control when your docs are sent out. You go into the portal, you create the documents yourself, you approve them prior to going to the customer. This allows you to do your documents after hours, on the weekend, whatever is convenient for you. And all of those documents are sent via DocuSign. I'd say at least 95% of our deals are done via DocuSign. Obviously, we're flexible. We still have the ability to create the documents. We can still do paper docs. I know there are people out there that still actually go to their customers and have them sign in person. So that's still, an opportunity that's available. Our portal also includes a pricing tool for you to be able to use while you're quoting your customers. It's really nice. It has slides for commission term, where you're able to, while you're on the phone with them, you're able to make adjustments till you find a payment amount that fits your customer and works for them. I usually get online with my partners and walk through the portal the first few times they create documents, and I can walk through it with you. I have heard from many partners that use our DocuSign portal that it's the most user-friendly and the easiest in the industry. They love it. That, coupled with our amazing funding team, allows for super fast funding at Channel Partners. So our goal is we want to build good partnerships. It's important to us that we're a good fit. We want to learn from you what you need and what we can do to help you grow your business. We're very good at, we always want, the more feedback you give us on our processes, on our portal, anything, the better. We act on that feedback, and we thrive on the feedback. So working capital, I will hand that off to Adam.
Adam, before we go there, just a quick note. Stacy had good description of the technology. We have today 9 folks in our IT group, and then 3 what I'll call sort of permanent contractors. And we build anything that touches your business or your customer's business. It's likely we're building that ourselves. And that what comes out of it, and Adam, I think maybe you're going to speak to this a little bit, but what comes out of it is a customer oriented, user friendly system that you guys had input into, and that's what we try to build. And I think that's what the system they built on the documents was guided very much by a group of folks that were, first of all, on the working capital side, but then second of all, on the equipment finance side that were using it and guided us to that. So the technology is a strength and will continue to be a strength of ours.
Yeah, and some of the things, just to add on to that a little bit, Brad, one of the things that we're developing right now, well, first, let me back up. I mean, like Stacy and Brad had said, we did a soft launch in August of our EF group, few partners just to get some feedback and just to test things. Found a lot of places that we could make some tweaks, and that's where the partner feedback is so valuable to us. Is we know we're not perfect, nobody is, and we're constantly evolving and building out, and it's your feedback that helps us really define who we are, how we build, or what we build. One of the things that we are very intensely focused on is SLAs and automation for our partners. Like Stacy said today, we do have a scoring model that is a tool that our underwriters use, but every deal is looked at by an underwriter. Over time, what you'll see from us by the end of the year, we'll have some automation in our credit decisioning, and it's not automation across every risk tier. The way we think about automation today is all of us have really good deals that come across your desk that doesn't take a lot of time to underwrite. You know, that's a 589, you know, that's a 6.5 credit. We should be able to automate the best deals faster for you to get back to the end users. And then on the other side of this, you have a bunch of deals that are tougher sometimes. And if we can automate some of those declines, you can either move that deal to the next lender or move on to the next deal. But our goal for automation is freeing up the credit folks' time to really spend the time in the middle credits, trying to figure out a way to get comfortable, trying to figure out how we can structure a deal or get a deal done. That's how we think about automation, and we'll likely have some automation on the top end of the credits and the bottom end of the credits by the end of the year this year.
We have a quick question. What is the max broker fees we can add to a deal, and do we get to add the points, or do you do that?
Me to take that one?
Yeah, go ahead, Stacey.
Okay. You add the points. We give you a buy rate, and you would add your points in there. And up to 50,000 is 12 points. 50 to 100 is 10 points, and then anything over 100,000 max is 8 points.
That same numbers for working capital, Adam?
Similar, not quite the same. Working capital is going to be 12 points up to 150,000 and 8 points north of 150,000. You want to move on here to working capital? Okay. So a couple of new things that are going on with channel partners. I know we've been in the space since 2009. We just launched the fourth version of our model, which is a really big deal for us. We think it's the most predictive model we've ever built on the working capital side. So we're really excited about what it can do for our business and our partnerships together. I think it helps us buy or identify the top ends of the credits and the bottom end of the credits much better. But because of the confidence in the model, we now are going to 250,000 on 3 months banks, where historically we used to cap at 150. So today we are going up to 250,000. SLAs on our working capital product, we're running about 2 to 3 hours on approvals, and we can fund same day up to 250,000 once that approval's out. every time we issue an approval, that deal has been fully underwritten and ready to fund. I know Stacy had a couple of deals that came over working capital, and she said, I can't believe how easy this is. But
Totally different than EF.
totally different product. One of the things that has really changed with our working capital is the payment frequency side of the business. Historically, working capital companies have been primarily daily, and then they migrated a little bit to some weekly stuff, but it's always been what I'll call a gap for equipment finance companies, that the payment frequency was so different than what you guys were used to selling. So we have created some monthly products today. And it's not a monthly product on a unicorn business. Today, monthlies are about 35 to 40% of the overall portfolio on a monthly payment frequency. So it's a meaningful component. 50 to 55% are on weeklies, and less than 5% today are on daily payments. So we've really almost eliminated the daily payments from what we do on a day-to-day basis, which just brings our product a bit more conventional from what it historically was. We do look to just like on the EF side of the business, we are really focused on custom programs that allow you guys to go compete within your market. We typically like to do that with folks that have some niche verticals. So let's say you had a big component of your business that was medical. We are open to going and designing a program in the medical space to help support your business or your vendors or your end users. So that's something that has always been core to our business is how do we add value? And if you're niche in something, we want to have a discussion about how we can customize what we do or how we do it to help support your business. It looks like there's a question here.
Yes. So is it a revenue-based or MCA loan, or is it strictly credit-based?
Yeah, good question. I'm going to say it's a little bit of both. Credit is what dictates approval or decline for us, but the actual amount that we'll lend to somebody is revenue-based. But everything starts with credit for us. So it is more of a credit-based decision that will dictate the approval or decline, and then the size of the revenues will dictate how much we'll give somebody. Typically, we'll lend between 10 and 12% of what somebody's annual revenues are. So if somebody had $1 million in annual revenues, just a general rule of thumb, we'll typically lend between 100 and 120,000 to that customer.
And the other thing I would add is we're primarily business loans,
Yep.
a loan agreement. However, there are a handful of states that for regulatory compliance purposes, we do a business advance, and that the structure of that deal is a factoring kind of product where somebody can request to have their remittance changed based on the percentage of their revenues. But that's Adam, I don't know, maybe 15% of our business or something. It's state driven.
Tim, do we have any strictly credit-based loans or startup loans? Unfortunately, no, we're not doing any startups or purely credit-based deals today. That's just, even on the EF side, we're not really doing any startup business today. We really want to see 1 to 2 years time in business for us to look at the deal. So let's talk about a little bit of a new product that we launched. We launched this in August. I'm sure a number of you have done some of these. But the reason that we built CPC Select is there was always a historical gap between your conventional EFAs, the rates, the payment frequencies, the terms that were offered. That we still did a number of really strong credits, but we felt like there was a bigger opportunity to close that gap between a leasing customer and a working capital customer. So we built CPC Select. The terms are much longer on it. Out of the gate, we're going to 18 months on those deals. So it's still not conventional financing, but we are going to 18 months on all those deals. Every single one of the CPC Select deals has a monthly payment frequency today. Now, if you look at those customers, what we're really seeing with those is the average annual revenues for those customers is substantially different. Our historical business, customers would have averaged about $1.5 million in revenues. With this product, they're averaging between $4.5 and $5 million in revenues. So they're more well-established businesses. Folks, I'm sure that you're leasing equipment for every single day. The average FICO in this portfolio is 725. The average 7 years time in business. So the reason we put that in there is as you're talking to a customer, those are some kind of good gating criteria that you'll be able to identify whether they'll qualify for CPC Select. But I would say the rates on average are about half of what they historically were on working capital, maybe a little bit higher than that, but about half. So it's really a differentiated product that is not universally available in today's marketplace from a rate or a term or a payment frequency standpoint today. So anything you'd like to add to that, Brad?
Well, I would, I'm gonna tag on to something you said earlier. So when we got into this business, when I got into this business in 2007, when we started Channel in 2009, Adam, we used to think about how much we would loan somebody or how much we would advance somebody as 5 to 6% of their annual revenues. Okay, and we didn't back then. The industry didn't do B2B kinds of businesses, which is what we mostly do, because that's mostly what your companies do. But to hear Adam say we do 10 to 12%, that's double what we did when we first started, 12 years ago, or when I got in 13 years ago. The industries that we service are much different. And Adam, I would also say these rates you say are half. The buy rates are lower really than half of what they were prior to starting CP Select. And then if I went back to 7-8 years ago, Adam, they may be in some cases 25% of what they were back in those earlier days when we were kind of out front introducing the working capital into the equipment finance space. It's amazing how much this business has evolved, and the whole point behind this is that we know that there's a number of companies out there that have said, hey, these are my best customers. I don't even want to talk about working capital because I don't want to go out with a 35 or a 40% rate, right? And we get it. And so this whole product is designed to take that into account and hopefully give you more confidence that where there's the right fit, you have a product that you can at least offer and have confidence that it's monthly payment. It looks more traditional, and rate wise, it's more traditional, or it's way different than what you would consider. That's me rambling.
So I'm not going to spend a lot of time in talking through each one of these bullet points. Just more philosophicically, our main goal here is to find a way to win together. We truly feel that if you got to go slow to go fast. So one of the things that we always preach when we onboard a new relationship or we start working with somebody new is let's look at a couple deals. Let's really get to learn your business. Let's have you get to learn ours. And if we need to make tweaks in ours to better support your business, let's do that. But we really preach go slow to go fast. And that's all centered around how do we go win together and truly help add value to your business in a differentiated way. Because at the end of the day, if your business is growing, then we're growing together. So that's really the core philosophy of Channel Partners is win together. So anything you'd like to add to that, Brad?
No, we appreciate the time. I know Monica kind of came on, give us the we're at 2:30 and Brad talked too long. Look, there are looks like 3 questions. Monica, can we quick touch base with these?
Brad,
Yeah,
if you don't
that's
mind.
actually what I was coming on to say. We had a few questions. So Paul says the majority of our business is referred to our company by established franchisors to finance new franchisees. Do you set up programs for specific franchisors?
Paul, I would say, yeah, it's a really good question. Paul, I would say let's catch up offline. I'd like to understand a little bit more about specifically what type of franchises, what do the credits look like, that kind of stuff. But I think absolutely we'd be interested in having a discussion about if there's a way we can partner and create a program around it.
We've done a lot of business in the franchise space.
Yep.
Next one, what is your minimum credit score in the equipment finance program?
So our preferred FICO is 625 and above, but there's so many other things that go into, what we're looking at for credit, as far as we pull a PayNet, so we're looking at their business credit, we pull another business report. So there's so many other things that go into it. And it all depends on why is it below 625? It's all going to be looked at as a whole.
Okay, so Adam, I see you writing down Paul's email address. Can you flip to the next screen for Rich so he could get your guys' contact information by the way, that last one was just a reminder, we're gonna draw 10 names and we'll send that out to everybody about who got the free passes. I'm hoping John Bottingheimer gets one. That's what I'm hoping, because we're friends from a long, long time ago. He helped me get started in this business. Okay, so Brian Spratt.
Yes. How do you feel about customers that have balances with other MCA lenders? What if the modified a payment in the past COVID related?
Yeah, good question, Brian. So on the first part of that question, we would pay out, the customer has to net at least 50% of whatever our finance amount is. So if they had a competitor balance, we would have to pay it off. We don't do any stacking or second or third positions, nothing like that. But just they have to net at least 50%. So let's say their balance was 50,000. We'd have to do at least $100,000 loan, so they have to net 50,000. We do cap our payoffs at 50,000. So we're not doing a $250,000 deal and paying off 125,000 to a competitor. But that's how we look at it. In terms of a COVID modification from another lender, I think that's a really great question. And I think we'd have to take that in almost a one-off deal, depending on the strength of the credit. I mean, we had a number of customers in our portfolio that if you think back to last March and April, you didn't know how bad it was going to get. And a lot of people, I think, proactively took modifications. We had it in our portfolio. Doesn't mean they're bad businesses, and I don't blame them for taking the modifications. You didn't know where it was going to go. So as long as that business has rebounded, I'd like to know about it up front, but as long as that business has rebounded, stayed healthy throughout this, I don't think that would materially distort our credit decision today about whether or not we would lend to that business or not lend to that business. Would not be an auto decline reason. I'll say it like that, or a decline reason in and of itself.
Great.
Anything you can add to that?
Oh, I was gonna, from a technology standpoint, we've got some really cool stuff that we do with bank data. And it helps us look at historically revenues in a bank and how those perform over time, and that's really helpful in our business. So to Brian's question, if somebody had that, you would be amazed at how many companies, probably 85% of the companies, were back to normal or near normal revenues by late June of 2020. The economy recovered. The dip was big, but it came back much quicker than we would have all expected. And with the exception of some geographic differences, that holds true, almost regardless of industry, although there are a couple of, obviously, restaurants in some areas were slower in coming back. But I think that question, if we saw somebody that we were concerned about, it might be more of a let's just gather a little bit more data and look a little deeper.
Okay,
So this is John's asking if my beard helps when I do my ice fishing. Yes, but I only do ice fishing inside a hut where it's warm and there's alcohol. So that's really it really, although it makes me look like I'm appropriate, it really doesn't help my fishing. But anyway, thanks for asking, John.
great. Well, it looks like we've gotten through all the questions. So with that, I'll close it out. I want to thank all the participants today, especially our valued funding source member and gold sponsor, Channel Partners Capital. Thanks for a great job, everybody. We invite you to meet with Channel Partners in person at our annual conference coming up this September in Nashville, Tennessee, September 8th through the 10th. Thanks again for joining us and have a great day.